Welcome, this is Raghee Horner, and we're going to be talking about GRaB, G-R-A-B, the green, red, and blue indicator, as well as the 34 EMA wave that you'll see running across all my charts. Now, this discussion that we're going to have today isn't just about an indicator or some moving averages, but rather it's about how do you gauge strength and weakness on any time frame and understand the market trends so you can best apply a strategy that will reflect what the market is doing. In other words, if you notice the market's trending, you can then go look at your trending indicators. If you know the market is moving sideways, you can go look at oscillating indicators. There are trending strategies, there are oscillating strategies. So how do you know when to apply which? That's what GRaB and the 34 EMA wave will help you out with. What we're looking at here is essentially a basic chart, a basic blank chart, candlesticks. So if you were to open up a brand new chart on your IBFX floor platform, you'd notice that once you remove all the indicators, this is what you're left with. Now, I realize there's probably people who are excellent at reading price action and can determine what the current mood of the market is here just by looking at the candles, and that's great. I think if I were looking at only one or two charts of maybe one or two pairs, that'd be something I could do as well. But the reality is I'm looking at upwards, simultaneously, I'm looking at upwards of 24 to 32 charts. I'm looking at 3 to 4 screens of actually up to 32 charts, 3 to 4 screens of 8 charts each. I'm looking at a 5-minute time frame sometimes, 15, 30, 60, 240 minute, and a daily. Heck, even sometimes I'll jump over to a weekly like I did for today, May 12th, daily trading edge. So when you're looking at that many time frames, what the advantage is of having visual tools like the wave and like GRaB is that I'm able to determine what the market's mood is at a glance, because there are certain visual cues that I've trained my brain to look out for. Nothing more, nothing less. I don't need extraneous analysis, meaning if I am looking at a trending market and my wave indicates that the market's heading lower, then I will go ahead and just focus on the support and resistance that will likely trigger some sort of corrective entry. I won't necessarily concern myself with patterns like triangles or rectangles. I won't necessarily concern myself with oscillating indicators. I can narrow down what I'm going to use. That's the advantage, okay? If you're curious what the advantage is, that's just one piece of it, okay? So let's go ahead and look at this chart with just the wave on here. So we're going to set the wave up real quick. 34 period. Exponential moving average. I'm going to set one up on the high, which I typically like to have in a green color. So there's my 34 period EMA high. I'm going to go back up to insert indicators. I'm going to grab another moving average. We're going to do this a total of 3 times. I'm going to grab a close. This one I like to basically plot in blue. I always have a difficult time finding a blue that is actually relatively easy to see on the black background. That sky blue seems to be doing the trick. And then finally I'll head back over to trend moving average. This time I'm going to go to a low, which is just fine in a red. And we'll see, where's that red? There we go, that'll work. And there's the wave. So looking at this 1 hour chart of the Euro US dollar within the look back. Now the look back for this chart, for a 60-minute chart, for all 60-minute time frames, is going to be 2 weeks. So I want to focus on 2 weeks. If it's a little bit more, like it is right now, that's fine. That's absolutely fine. And I take a look at the angle at which my wave is moving. Now here's the nuance that I think is really helpful. Prior to what we're seeing now on the right edge of the chart, prior to this, we were trending lower 4 to 6 o'clock. Notice now there's a subtle change. There's a transition. Prices are doing what I call they're rolling over. They were moving downward, now they're kind of rolling over, flattening out the wave. If this persists, I'm looking at what was a markdown cycle to what could be an accumulation cycle, a downtrending market to now a sideways, less volatile market. If I jump over to the 30-minute chart, the 30-minute chart has a look back of basically 1 to 2 weeks. So here I have about 1 week, and I can see what that rollover is when I go to a 30-minute chart. So here, that rollover is trying to settle into what will either be an accumulation or distribution cycle. The main difference being volatility. Understanding the difference between accumulation and distribution boils down to, is this a 3 o'clock wave, so it's a 3 o'clock angle, or is this a 2 to 4 o'clock angle? The reflection of that will be the volatility we see within the range. Higher volatility will usually create more of what I call a wiggle and make this wave 2 to 4 o'clock. So as long as I understand the difference between the two, I know whether or not prices will break out, break down, as if they would from a rectangle or triangle with momentum, or whether I'll be expecting exhaustion up at this high or exhaustion down at this low, and see prices basically continue to bounce within this range. That will all be determined by the market cycle. So I'm letting the mood of the market cycle, or the market trends, as Charles Dow called them, determine what type of entry strategy I will apply to this market. And the only way I know to identify the market trend, the best way I know to identify the market trend, is a combination of this 34 EMA wave, the 34 period EMA on the high, the close, and the low, coupled with, and this is important, coupled with the appropriate look back for the time frame. Now we're going to add another layer to this. We're going to add the color coding of the GRaB, which I think makes this visual assessment of the market's mood that much easier, and I'm able to gauge strength, weakness, and even neutrality at a glance. And that's where I think not just the accuracy, but the speed at which you can go over multiple time frames and multiple pairs and tackle a bigger chunk of the market and open up potentially more opportunity. Potentially, you got to do this right, but potentially more opportunity is available with, again, visual indicators. Look back, the 34 EMA wave, and then we're going to look at the GRaB here. So let's do that.